Hello, and welcome to Tuesday with Lloyds. My name is Enya, Regional Director and National Practice Leader in Risk Management for Lloyds US. Launched September 2020, Tuesday with Lloyds has been an ongoing dialogue between Lloyds market and our stakeholders in the Americas region. This year, our sessions not only bring the latest market update, but also been showcasing Lloyds Syndicate once a month, with the primary goal to keep you stay connected with Lloyds market leaders and field experts. Today it's my great honor to present to you the Property Insurance Roundtable featuring Alastair Blaze, Chief Underwriting Officer, WRB Underwriting, Justin Catling, Executive Underwriter, Property of Ascot, Richard Wood, Group Head at DNF Property, Lancashire. Moderating today's session is Garner, Executive Vice President of CRC Group. Today's panel is very special, not only because they bring wealth of knowledge and expertise in property insurance, but also this is a group of leaders who truly believe in the value of Lloyds and who are passionate of insurance. In particular, what makes this special is this is for the first time the panelists are all in one room together as a true roundtable. We sincerely hope this will mark the beginning of a new phase for our market. A few housekeeping items. To better serve you, we'd like to get a sense of who you are. So please take a moment and answer the polling question on the screen. And secondly, to help us better organized, we encourage you to ask questions in the Q&A tool, which is best way to talk to our speakers. And lastly, our session is being recorded and live streamed on our YouTube channel. So please share with your colleagues who are able to join us. Without further ado, please welcome our panel. And Emma, the floor is yours.
Thank you so much. And thank you so much for having us and inviting us to be part of this, which we're very excited about. We'll get started. I am honored to be here today with Richard Wood, Alastair Blaze, and Justin Catling. I did the quick maths, and between the three of you, there's about 99 years of insurance experience between the three of you. So I think we're definitely in good hands, which is a great start. Thank you all so much for your time. I know you're in the same room, although it doesn't look like you are. So no kicking each other under the table. Let's get started. If you guys can give your brief bio, tell us a little bit of your story, and we can go from there. Richard, you want to start?
Yep. Good morning, afternoon, or good evening, wherever you are. Yeah, you're correct. We're all in one room, which is in itself quite exciting. But yeah, 1986, I came into Lloyds as a young-faced lad. I began my underwriting career on a non-marine property box. From that moment until today, I've had various roles in various places, but always on the underwriting side. I've never been to the dark side of the broking world. Never understood it. So, passionate about the marketplace, an advocate of the longevity and lifeblood that is the Lloyds marketplace, and, been from the big syndicates to smaller syndicates, and been at the Lancashire Group now for 17 years. So that's a little bit about me.
Great, thank you. Justin?
Yeah, I think when you put that stat up about, nearly what it talks about 100 years, I felt about 100 years myself, I think. I've been in the industry for nearly 30 years. Started on the dark side, on the broking side, in the accounts department, at the fresh age of 23. Didn't really know what insurance was about, in all honesty. Sort of stumbled into it, lots of people do. And then I started, I did different roles for that broking house, had a great career there, met some fantastic people, and started underwriting 12 years ago at Ascot. thoroughly enjoy every moment of it, in all honesty. So thanks for having me on the panel. Alastair?
Great, thank you.
Hi, Emma. So I've done at least a third of those 99 years, and similar to Richard, started in 1986. Was very much a junior for the Liberty Syndicate, where you weren't allowed to speak to the underwriter. But through my career, I was seconded to Sedgwick in London for 6 months, and the subsequent year, I was seconded to Marsh to really understand a bit about a global broker. And I left Liberty and joined Beazley. I was there for 14 years as the property underwriter at Beazley. And then subsequent to that, I went and joined WR Berkeley to start WRB Underwriting in 2009. And I'm at WR Berkeley today.
Great, thank you so much. Okay, let's get started. We're going to start by asking you guys just for a Lloyd's market update. I think, Alastair, we're going to get started with you. If you could just provide us an update on the Lloyd's marketplace and what's going on.
Okay, well, thanks, Emma. I mean, no one could have envisaged what we've all been through, this global disruption, the continuing pandemic, and everything that's been thrown at us in this last year and a bit. I mean, it's been over 400 days now in the UK since we've had various periods of lockdown. We've been in and out of homes and offices. And I think to start with, there is some light. So when we come to Lloyd's, there's a plan to return to the market, both brokers and underwriters, from the middle of May. Which is pretty exciting. We're starting to see offices fill, and there's thoughts of returning back to Lloyd's at the middle of May. And then we were chatting earlier, and I mean the three of us today, you know, there is so much good that comes from being together, interacting, and outside of these lockdowns, you know, it's been fun to be back in the office with our colleagues. And you know, we can touch on this a bit later, but the reopening of Lloyd's, I think, for the three of us and the things we will talk about, the face-to-face, I think is really important. But turning specifically to Lloyd's, I suppose the impact of the pandemic's been considerable, both financially and organisationally. But the strength, resilience, and determination of the market has been quite extraordinary. Brokers and underwriters, you know, in a weekend moved to a total, you know, remote working and trading environment, which is testament, I think, to the resilience of the market and some of the progress that Lloyd's has made over the last few years. But clearly, it's been a different 2020 was a difficult year, and John Neal, our CEO at Lloyd's, reported the results the other day. You know, Lloyd's is materially affected by COVID. Excluding the impact, the underlying results are strong. And much improved from 2019, which they needed to be. I mean, the market wrote £35 billion worth of premium, but delivered a combined ratio of 110. And if you strip out COVID, that delivers a combined of 97, which is a 5 percentage point improvement on the prior year. Rates continue to improve, and across the market delivered a rate double digit of 10.8%, and that increase was a positive rate across all classes and all geographies. The market did pay 21.4 billion of claims, of gross claims paid last year, and they've put aside 6.2 billion of COVID claims forecasts, and these are before reinsurance. And of course, 2020, certainly from a short tail perspective, was not without its catastrophes. So it was the 5th largest year on record for catastrophes, with 28 insured losses in excess of £1 billion. And this is compared to 2017, where the market recorded 18 events above £1 billion. So a very challenging year for the market as a whole. Central solvency remains very strong at over 200%, and all the rating agencies, S&P A+, AM Best A, and Fitch AA-. But if we drill a bit into Lloyd's in the US, still Lloyd's is the largest surplus lines insurer in the US. And Lloyd's is also the largest non-domiciled reinsurer in the US. And the US accounts for 53% of Lloyd's business. So I think, when we sit here and look at the importance of the US market, particularly across all classes, but for us in this room today, I think the importance of the US market from a property perspective. And another point of data, without putting too much on the table today, is that 40% of Lloyd's global premium is actually held by US customers.
And Alastair, I think it's probably worth interjecting at that point to give you a moment to catch your breath. But I mean, just on property alone, Lloyd's wrote in 2020 9.2 billion of premium. As you said, it was a very tough year. It was a tough year, and the overall result, the Lloyd's property line accident ratio for the 2020 year was 135%. As you highlighted, a very tough year, a slew of hurricanes and natural catastrophes and events, plus what you alluded to about the COVID. So all in all, a very, very tough backdrop, but fundamentally some improvements in the underlying loss ratios, which is very encouraging.
Yeah, and again, in terms of historical perspective, 2020, I mean, the market for 5 years is collectively run at 131.9% from a property perspective. So it's challenged. It's severely challenged around some items of fundamentals, and we'll get into that a bit later on, talking about pricing and market dynamics a bit.
But I think to continue to attract the right capital, continue to move forward, we as a property market, in particular US property market, need to manage these cycles and find ways of improving.
Definitely.
Okay, thank you, Richard or Justin. Anything to add to that? Or
I think it's probably worth. I mean, it probably leads on naturally to some other topics, but I think the difficulties that we've had in the underwriting climate, the soft cycle, the improvement in the attritional loss ratios that we've begun to see, is all very encouraging. The business planning process that the syndicates have to go through is rigorous and much more rigorous than it was in past days. That has undoubtedly helped. It's metaphorically raised that bar for us as a marketplace. The accountability of the underwriters, the deliverance of the plans and the loss ratios, as I said, the expectation is much higher that we need to maintain and push and maintain our higher standards.
Right. Okay, that's great. Thank you. Can you? We're coming back to you, Richard. We're going to start with you. Why choose Lloyd's? If you're a client or risk manager on this call, why would you choose Lloyd's to place your insurance with?
I think Emma, we've done this a long time collectively, but unquestionably, to the outsider, the Lloyd's proposition is complex, but it's a fundamentally stronger method of risk transfer. Why? Because of the way that we syndicate, and syndication is a word that people don't necessarily understand. We have a very complex capital base with pools of capital from across the globe that syndicate and share the risks. We share our underwriting knowledge. We share our underwriting expertise. The market will price risks individually. We have leaders that will set the terms and conditions, but the market will set the terms, and it's a fairer overall, a fairer approach to pricing through the cycle. And I don't think for one moment we would ever pretend to be the cheapest market, but we will hands down be the most consistent marketplace. That is why I believe, we offer a proposition to the clients out there, the broader base. We're consistent with the way that we approach the challenges that the market throws at us, and this year's was COVID, but we traded through that and we dealt with it. So, the Lloyd's marketplace brings capital from all over the globe, the access to the licenses across the globe, the superior rating of the marketplace, the global reach, and world-class relationships across the brokers, the underwriters, and all those that support the marketplace.
Richard, I think one of the other ingredients is dealing with the decision makers. And we might laugh that we've been in the market for 99 years, but we're still passionate about actually we're an underwriting-driven business, underwriting-driven businesses, and that's what it's about. And we've missed so much in this last 12 to 15 months. Again, we were talking earlier. We've missed the retailers. We've missed the wholesalers. We've missed the clients. We've missed the interaction.
Yeah.
But it's dealing with the decision makers. And ultimately, I think underwriting is the best job in the business. And I'm still seeing clients, still doing the deals, still building relationships. We're seeing new business, and we're coming up with solutions for these businesses. And that's the business. That's the fun of it. It's dealing, and it's being accountable.
I mean, I think, Emma, where else in the world do you get that degree of passion? We are bothered about what we do. We're intrinsically linked to the business, but we're all still, we're old in the tooth, if that's the right expression. But we're all still passionately involved in what we do, and we're committed to the longevity of doing business through the cycle. I think, it's easy to sit in front of a client or a cover holder and talk about what that particular issue might be at that particular time. But it's building these relationships and building the predictability of the unpredictability of the underwriting cycle. We are. Yeah,
I mean, I think the key part of it is that syndication, as you say, it builds resilience, a natural resilience into when there are significant events, because not everybody's doing the same thing. There'll be risks that we're not on the same risk. We'll have different opinions around that particular risk. We'll have different interpretations as to how that fits within our portfolio, and have different risk appetites within the room. There's enough competition in that room for the brokers to be able to build a slug of capacity, but also, again, if somebody falls over the following year because they've suddenly decided they don't like writing aluminium smelters or steel mills, somebody else will try and restructure a deal that makes sense to them so they can enter that arena and write that class of business. So, constantly that's what we're trying to do. We're redesigning placements, particularly this last 12 months when there's been a lot of business that's come into Lloyds that's been distressed, lots of clients that have had single carriers who have walked away, and we've tried to find solutions and tried to find a way that makes these accounts fit into our risk appetite. And what we're trying to do with that is build longer term relationships. Our average hold is 8 to 10 years in terms of a connection. And that's important to us because that data set that we have in our heads and on our computers and in our systems gives us a reference point through the cycle in terms of trying to manage the volatility that's in our book. Yeah. So that syndication is really, really valuable. And again, if I'm getting pressure on a placement not to do it, somebody can just go 2 boxes over or 3 emails over and try and find a solution here. So I think that's a really important part. It's a unique part of our marketplace. Yeah,
I agree. And, we've certainly seen personally much benefit from clients coming over and meeting with Lloyd's underwriters, and they seem to love it and, respect the fact that you guys are in it for the long haul. So, I think that is always been a great thing. Do you want to come back, Alastair, quickly? We talked about 2020 results. Seems to me that we're seeing on our side more business being placed in Lloyd's this year, or more coming out of Lloyd's this year. Do you think is that a true statement? Like, are you guys writing more this year, would you say, in general?
We're definitely seeing more. The challenge is sometimes it has become slightly more clunky. I mean, the mass Zoom calls are something that haven't worked, but the submission volume, we're definitely seeing more. We're definitely a quoting market, and depending on risk appetite and, you know, does it fit Justin's syndicate, Rich's syndicate, my syndicate, whatever, really depends. But the volumes of business are coming. Is it all sticking? No. Again, are we better in front of the retailer, wholesaler and client? And I'd much rather shake hands and do the deal like that. So some business we're losing in translation. I think hence our determination to get back face to face. But definitely, I mean, the volumes are up.
The volume's significantly up. I think one of the key things for us in when we're trying again to deal with volatility is to try and control attrition, to try and control who shares what of an everyday loss when we're looking at a particular risk. And I think, you know, speaking from personal experience, that dial hasn't moved at all, really, in the last, certainly not since I've been underwriting. Didn't really move when I was broking around, apart from the catastrophe percentage deductibles and that share. The clients continue to take the same monetary deductible for the last 15 years. Now, logic will tell you that $100,000 15 years ago is infinitely worth less than it is today, right? So, worth more than it is today. And therefore, you know, we haven't kept pace with inflation. We haven't kept pace with, you know, the connectivity that businesses have, the business interruption, CBI, the global nature of customers. We haven't kept pace with that. And the risk sharing element hasn't been in the right balance, hence the performance of the market, hence the general performance of the market. So this year's been really, or last year particularly, was very reassuring from that perspective, is that you could try and find a position that made sense for both parties, where that we were going to be giving you a check when you had a significant event at your factory or your office or your hospital, but we weren't paying for somebody breaking the toilet or doing something that's quite minor that should be dealt with by the assured.
And if I can jump in there as well, I mean, I certainly at Lancashire, we've definitely written more business. Unquestionably, we've seen a lot more business. And I think my takeaway from that question or that observation is, you know, whilst other markets overnight changed their appetite for risk, and we saw plenty of that across the broader spectrum, you know, the marketplace, the Lloyds marketplace was there to review and offer solutions when others wouldn't. And I think the value of, you know, sharing business, of sharing of global placements, of, you know, having a global broader spread, unquestionably that got called, you know, I think it was, you know, palpably clear that the Lloyds product is a better product. We saw a lot of clients come into London, come into Lloyds when they were, you know, when others wouldn't offer capacity, wouldn't offer renewal. So, you know, I think it's a definite yes from my camp. We've definitely seen more, and we've definitely done more and been far more proactive.
The speed that the market can quote as well is incredible, really, from a broker's perspective, even with COVID and being remote.
Yeah.
You know, we try and turn things around within 24, 48 hours, and it's either a yes or maybe, or this is what it looks like. It's not a protracted 2-week conversation. We're trying to compete against, you know, each other. We're trying to compete against the global insurance market, and that requires a quick response. So, you know, again, that helps the London broker, that helps the retailer in the US get a response when their client hasn't got a placement together.
Yeah, for sure. That's great. Thank you, guys. We'll just touch on, you know, obviously technology's been advancing on so many levels. Do you still think there's an importance in the Lloyds face-to-face underwriting? You know, brokers, like I remember lining up for like 2 days to see some of you guys, and then having people just walk up and go on vacation and not come back. Wasn't you two? Wasn't any of you guys? But that did happen to me.
I remember that as well from my broking days, I can tell you, yeah.
So do you think there's still importance in that face-to-face underwriting, Alastair?
Absolutely. I think it's been more challenging, I think, for the brokers in London. it has slowed down. So being totally remote, whilst that's, the pandemic's highlighted the importance of being able to trade, and Lloyds have done that very well and made substantial progress in doing that. It is clunky, and I think you get quicker decisions when you're face to face. There is still the negotiation. We've got the technology sitting behind us. We've got all the data, but there's still the art to the underwriting. And we were laughing the other day on a call about risks that we've written and how we learn and mistakes, and whether you're a junior sitting inside the underwriter, learning in that way. So there's a lot of elements of the face to face, not just with the underwriter, but across the business. Sitting next to your claims person, sitting next to your pricing actuary, all these things I think add value and add a better decision and a better outcome for our clients.
Yeah, and I think what's important is that it's far easier to decline a risk on email. I'm being really honest. I mean, if somebody sends you an email and you don't like it or they haven't given you the full details, your journey sort of stops there, and then you require another email to come back for you to start the journey again in terms of your discussion. The art of broking as well as the art of underwriting is around taking the underwriter on that journey and trying to formulate a product at the end of it, so you don't get up and walk away after with nothing at the end of it, right? If you got up and walked away from your broke and you achieved a declination, you were probably in the wrong box because you haven't known what the underwriter's appetite is, and you're probably in the wrong place in the first time. Everybody has to have an efficiency of time. The market's moved a long, long way from that standing in the queue for the underwriter to get up and walk away and say, I'm coming back in 3 days' time, I'm off to the south of France. Brokers contact me, they get an appointment, nobody queues, I will respond on email. So the market has already done that, and we'll talk about technology a little bit more, but I think brokers miss that dialogue more or as much as the underwriters do, in terms of feeling that they get an end product from the customer.
I'll tell you, if I jump in there, I mean, even sitting in this room with the three of us face to face, it means so much more than trying to do this electronically, as it would do with a broker or with a client or a cover holder or whoever it may be. I think we've all recognised there's tremendous value in being able to exchange ideas quickly and efficiently. I don't think anybody thinks that anybody queuing in a line is a very efficient use of time. But equally, there's a tremendous amount of value in being able to sit down and articulate an angle from wherever you are in the chain. So I think we're all heavily wedded to the value of face-to-face. And let's be honest, that's what makes London, and Lloyds particularly, a more unique marketplace. So we want the best of everything. And as we come back to London, as we come back and re-engage with our own teams, but also with other teams and other markets, boy, have I missed this. And, does it add value? Absolutely. And are we looking forward to, Emma, you bringing all your clients and customers over to visit? Absolutely. We want to re-engage with them. And I think it's very clear the value that brings. Yeah,
for sure. Although I can tell you, I learned a lot about what my competitors were doing standing in line. You learn to read upside down and, or
not doing, right?
Or not doing, as the case may be, right? If we can, thank you guys, if we can kind of move on to over here in the US, it seems that, we've had the 1 in 10,000 event every year for the last 5 years. So what do you guys think about how Lloyds is going to handle, what appears to be this new normal of extreme kind of localized cat events? Justin?
Yeah, well, I think, from a Lloyds perspective, there's definitely some increased oversight around pricing models and how people actually price for some of these remote or catastrophes, or unique catastrophes, really, some of them. I think what's really important for the market, on a more general term, is, and this is talking about the value of an underwriter again in the process, is that the market's sort of gone down the road of talking about the model all the time and using the model as a guidebook for pricing. And there's lots of things that are not in the model for pricing. You know, I constantly broke from clients, retailers, and everything else is about the AEL and everything else. I could sit here and list a whole sheet of A4 of things that are not built into that model that we've encountered in the last couple of years. So I think, you know, we're constantly challenging ourselves around that. We're constantly challenging ourselves around the vagrancies and the variances of the model. You know, it was designed, in my mind, for you to manage accumulations in your portfolio. But again, people are looking at it going, right, this risk, this is the amount I should charge for it. And again, it doesn't take it in. So if you think about the frequency, you talk about the severity of these localised events as well, Colorado hail, Uri, you know, I mean, you know, the floods in Calgary, wildfires. I mean, again, as you say, we could list off lots of these events over $1 billion that, you know, that have affected the market, and it, you know, they don't take account of the breadth of coverage that we provide. They don't talk about the individual nuances with regards to occupancies. They don't take in business interruption properly to an extent. CBI as well is a big issue with regards to interruption and service interruption, and Uri as well is going to be a factor from a claims perspective. So, you know, it's my big bugbear really. As soon as somebody says the model AAL, it's something that we step back and go, well, my value is, and our value as underwriters is to sense check that output, is to look at that, use our experience and still work out whether that's the right price for that product. Why do we talk about 250-year return periods and ask for a 5-year loss record? I just don't understand. I just don't understand, and it defies logic in my mind. So again, the value of the underwriter in this process is really important. We're refining our appetite all the time. We're controlling our aggregations. We're looking at things that are left field all of the time to try and take that volatility out of the book. And Lloyds will just be giving greater oversight to that, I think, in the next 12 months for sure. And that's what we've been told.
I think that's right. I think looking at I think European reinsurers have always pressed upon us the importance of pricing all the elemental perils and the depth of coverage. And maybe the reality is, Emma, you're too good at your job. You've got too much coverage in the form, you know, and the market struggles to price it all. But the reality is that's the market, so we have to deal with it. But yeah, we do find, you know, broad coverage, and do we understand the cumulative risk? But also, are we charging for it? And are we properly, from that perspective, probably the answer is no. But that being said, you know, that we continue to learn, we're developing, and you know, from that I think I feel more confident about what we do, the way we price risks than I ever have, understanding the pricing and the work that we do on the pricing of the elemental perils particularly.
But again, it's the longevity and learning from your mistakes. And we've all written risks which I can promise you would never model, and they've gone. Sometimes they go okay, and you think you might be okay at underwriting, and then something comes and catches up with you, you have a loss that you're not expecting, and yeah, we all need to buy reinsurance, and we need the data, and I think that continues to improve our underwriting. But like Justin said, there's a list of other factors that drive our decision making, which I think is absolutely key, and those are the factors that we need to make sure that that we share with our colleagues. And we can pass that knowledge.
I'm constantly being probed around again the AEL and told that, you know, because the clients told me that how the roofs are tied down and how the windows are reinforced and etc., and the risk is improved by 30%. But that should be a cost saving, and it's 2 years on from the model being shown to be incorrect in the 2017 events, right? So and the AEL being wrong there, and the 250-year result being wrong, and the loss being twice as high as it should have been. And it's not just about the AEL that drives cost in our business, it's losses as well.
Mm.
And losses have a severe impact on our reinsurance costs and our capital costs. And people try to discount that and say, well, no, you can't include that one, or you can't include that one because it's only a 1 in 1,000 and it won't happen again. You know, tell that to, Puerto Rico, for example. I mean, how extreme is that? 2 really extreme events in 1 year. And again, probability doesn't work in the manner of a binary fashion. It's literally, flipping a coin. It could happen over and over and over again. And that's where you need the human intervention and a sense check again. So, I think that's what the market needs to do. It needs to pull itself back and start to price that breadth of cover correctly to create resilience in the marketplace that enables us to move forward with this work.
Yeah, and would you agree that within Lloyds it's easier to kind of make those kinds of shifts than, because the underwriter and all the decision makers are in one place rather than a big company that you got to get around the country to get the message out to?
Within a day, you go and you sit down with your CEO and you have a conversation. Is this the right thing for us to do? No. Or have we looked at that? Yes. And I think that's we're constantly doing that across every product line. We're challenging ourselves, we're challenging our knowledge, we're challenging the product that we're selling. Have we got the balance right between risk and reward all the time?
We constantly change direction, and we change for each and every client. I mean, I think that's the beauty of the market. Again, you're underwriting, your clients individually, and you can change direction within hours. And it's nimble. It's speed of decision making, and again, it goes back to dealing with decision makers.
Okay, great.
That's great.
Yeah, and I think that's a really good point. I mean, the ability for the broker to articulate the client's needs, yes, but the underwriter can make a call on, these. We all sit on, a business panel in Lloyds, so we, despite our age, we still, we're involved day to day in the underwriting. We sit on the panel. We review market issues. We talk about things that, that we try to respond to changes within the market. So, unquestionably, it's the depth of our knowledge, but it's our connection to the marketplace that gives us the ability to react.
Right. We have a couple. We have a few questions in our Q&A, but I'm going to take a couple now and then a couple at the end. Just a couple now because they're relevant to this conversation. Somebody asked if the AELs are that inaccurate, that implies a need to work closer with the key modelling entities. So how do we impact that? I think is the question.
Yeah, well, again, it's just, we have teams of people that are doing this. We're feeding the information into them and vice versa back into us. And the connection with whenever there's a model update or a model change, we have an internal validation alongside of that as well. And we talk to the underwriters around what's driving that. I think there's a massive exchange of information from the industry back into the modelling agencies. It's more about the fact that, it's a retrospective tool effectively, right? We can't foresee that something's going to happen. We can't foresee that is going to happen tomorrow. And, this is the outcome. We're going to have service interruption. We're going to have chemical plants not being able to supply polymers. We're going to have
an event that covered 7 states and, over a period of time. There's only so much. The model is an important part of the ingredient and the output, but it is a part of the ingredient.
Well, it's not a crystal ball. If it was a crystal ball, we'd all be retired by now, and it would be an easy thing to do, right? But it's not. We're dealing with nature and wider threats that are out there, and climate change and all of the different dynamics that we've got, building up in previously unpopulated areas, and there's lots of things that are changing and have changed in the last. They're changing every year, every day, really.
I don't think one moment has anybody ever here saying that. I mean, modelled output, the model data, the way that models look at exposure and cumulative risk, that it's a very important part of the process. But I think it was Alastair that referenced, look, that's one of the tools in the bag. We don't rely on it. Woe betide the underwriter who relies on modelled output. We use it. We have to use it. We have to build, the better data sets for modelled events. But I think the question alluded to, should we work closer? And that, yes, is the answer. We would, and we continue to do that. We have to do that.
Right. And how much of your reinsurance is driven by the AEL? Is that another reason you have to kind of pay attention to the AEL because of your reinsurance costs?
Absolutely, yes. The reinsurance marketplace is particularly reliant upon modelled output and modelled, portfolio. You have to have that data. You have to have that understanding of the risk transfer. You can't ignore it, but you can choose to not underwrite around it. And it maybe it doesn't produce the perfect modelled portfolio, but it depends what you're trying to do. Remember, the model's available for those who are prepared to, those that supply. You can access it if you pay. So it's freely available.
Right.
But it's also about how do you compare one risk to another. So reinsurers compare one insurer to another, right? So for them to actually predicate based on volatility of each individual, direct insurer that they're covering. So there has to be a differential around exposure and concentrations and everything else, and that's what the model's used for as well. So yeah, absolutely, it's a key part of that, and that's why it's important. But again, when you take it down to the granular, will it hit this building or will it hit that building? What's one of those 5,000-year event when nobody's been living there more than 200 years, or 300, 400, 500 years, or whatever. It's just very difficult to get your head around those return periods. We're trying to look out over the next 50 years or 20 years or 10 years to make an underwriting return.
Yeah. Even I would make a good underwriter if I could look back and redo it with a crystal ball, and that's saying something. Somebody has asked, what do you see going on in Florida from a property insurance perspective? Do you think it's going to continue to harden into next year, or do you think it's going to start kind of edging off and pricing relief in the near future?
I
think you're breaking up there, Emma.
We're inundated with submissions, and we have some core clients that have bought policies with catastrophe perils in them for year after year after year, and that's very much part of the relationship. But yeah, we will all run out of capacity and reinsurance cover, and we need to write to a certain aggregate, either gross or modelled, however you do it. But we're going to see more and more Florida business, and ultimately that will drive the prices up.
I think for me, it's more of the same. I don't see the market necessarily changing out there, particularly. Do I think in the broader sense? Do I think the market? No, I don't see it changing. I think there are people doing things, there are markets doing things that weren't doing things 12 months ago. But I think Florida is a valuable commodity, and spend it as you choose. Underwrite it, reinsure it. It's a commodity that you have to be studiously manage. All the stages in the cycle. I know we've had a much stronger underwriting climate, but I see no reason for that to change.
I can still remember 2000. We can all obviously. I'll keep putting the references 2017, which is the last real significant, proper, huge hurricane activity. And some of the event sets that were lined up over Florida at that time were huge, right? And particularly Irma, and the market didn't get away with it, but it sort of escaped what could have been a really, really horrific thing. So we're absolutely concentrating front and centre as a syndicate, as an organisation, to making sure that we get that right. And if others are in a different position to us and have a different viewpoint from that, we're prepared to just be very prudent with that exposure. It is a precious commodity, and it is extremely volatile to everybody's balance sheets. Right. So it's a tough one.
Okay, thank you guys. Just moving on, you know, in the end, people buy insurance because unfortunately there are claims, right? So could you maybe each talk to us about a claims event or something that's been significant to you in your underwriting career? Richard, we'll start with you.
Yeah, happily. Well, not happily. I'll be prepared to start, but yeah, I mean, for me, there's only one thing that that stands out. I mean, 20 years ago, I was on my way to the NAPSLO conference in San Diego. I found myself in San Antonio. Thank you. And I found myself in the office in Houston. I went out to see a client. Went out to visit a client, and in their boardroom, they laid out some tea and coffee and the rest of it. And as we stood there and drank tea and coffee, the first plane went into World Trade Center. And from that moment on, I got a phone call from my boss, who was in Houston at the time. Richard, I think you need to come back to the office. So I went back to the office in Houston. We began looking at numbers. We began looking at scenarios. We had to wait until the daylight caught up with London time. We sat around the boardroom table and we tried to work out if we were still in business or not. Pretty scary time in the world of insurance. Pretty interesting time to be a relatively young practitioner in that marketplace. But more to the point, we returned to London when we could. We got back into Lloyds and we traded through it. You know, it was a very difficult time. It was a time of massive uncertainty. Boy, did we learn a lot. We learned a lot about a lot of things very, very, very quickly. But what we did do is we went back into the room and we began underwriting and we made the market and we offered, consistency to the clients across the broader business base. And so that's my little segue.
Thank you, Alastair.
I think at the other end of certainly the other end of the spectrum, I was very much younger than I was today, and
I remember those days without so much grey hair.
Exactly. And I thought I was understanding this underwriting business. So I wrote a supermarket in an international territory. I got a 4% rate. So even Emily,
I would have.
And I got a 4% rate, and it had 24-hour security. But unfortunately, the security guys, it was cold. They lit a fire to keep warm. The fire spread to the building, so not so good. Called the fire brigade. That's all great. So the fire brigade came and put the fire out. But then the fire brigade looted the building. Okay, they looted the building, and I just remember the claims file, my boss, and you just remember things in the industry. Unsprinkled sawmills become sprinkled sawmills and still burn down. Supermarkets at 4%. So a model's not going to teach you that. But again, a very different end of what Richard has said. But this is the insurance business, and things happen. And we're here to help and deliver solutions to your clients.
As you say, the unpredictability is that. You have a relationship with the risk manager, and they'll set out what they've been doing to make a risk better, and they'll talk about sprinklers, they'll talk about all the engineering, etc. But you can't sometimes factor in that human intervention. And my story I guess goes back to when I first started underwriting at Ascot. 3 months in, I renewed a piece of business, and it's very green behind the ears, not in terms of age, but certainly in terms of underwriting. And had a phone call from a broker on a Friday night in the supermarket as I'm walking around picking the wine out, telling me that the risk that I just renewed, 6 weeks before was on fire. And I'm like, yeah, go away, whatever. No, it's a really big fire. And this thing burned for 3 days. It was fully sprinkled. And they couldn't work out why. Why did this catch fire? Well, actually, what it turns out, it was the 4th of July, and an ex-serviceman decided that he was going to smuggle a military-grade flare from his army base. And whilst getting drunk with his brother behind a gas station, fired this military-grade flare off onto the roof of the building, and obviously went round the fire protection and burnt this building to the ground. And my CEO asked me at the time, he said, I was petrified that we're coming into work at the honest. And he said, well, what would you do differently? I said, I wouldn't have such a big line next time. Was my answer.
Yeah.
Which, that's the correct thing to do in that, you know, and you have losses, and then it's about how you respond to that and what you learn from that. And it's around occupancies, it's around people, it's around best endeavours as well.
Yeah. Thank you. Although my accounts don't have losses, we have had a few catastrophes that have affected Lloyds, and our experience, CLC, and personally, has been that Lloyds has always been one of the first to advance money and get ahead of it, which is great. Can you just maybe briefly, because we're coming up to 10 to 12, just a brief explanation of how you guys managed to do that so quickly when there might be 10 syndicates on a slip? Anybody?
Yeah, well, in simple terms, you now have basically everything centered onto the ECF system, which is electronic claims system, and you have a leader and a second syndicate that are responsible for effectively leading the adjustment process. The first syndicate, the lead, does it, and the second syndicate is a second pair of eyes to just test that. So that's created a great deal of efficiency in the marketplace, and the market's done a ton of work around that. It was, you go back 10 years, and it was a different world from where it is today because of that. And so that's the simple answer to that part of it, I think.
Under Blueprint 1, the Lloyds initiative, Lloyds have invested a lot in this through-to-through claim, digitalisation and the through-to-through claims input. And you've got the Lloyds claim scheme, and like Justin said, it's driven by the basically the lead, and it is of utmost importance to pay our valid claims as soon as possible.
Yeah, and you guys do a great job of that, which helps clients.
And Emma, it actually links back to one of the first questions that you wrote. Why with Lloyds? Why would you come to Lloyds? And I think when we all started in the underwriting process, our ability and the swiftness of paying claims wasn't as good as it should have been. It wasn't, but today it's world class.
Yeah,
and it's moved. It's palpably moved. It's moved in a much better place. So. We are ever improving, and as Alastair said, everything that's valid, we want to pay and pay very quickly.
So with we may have just moving on, if we may have touched on some of this, but obviously the marketplace is changing, the world is modernizing. What's changing in Lloyds, and what are you guys doing to try and stay with the times and yet hold on to what's important to Lloyds as a market?
Yeah, so this is obviously, as you say, we've got 8 minutes left, and we could probably talk for about an hour about the second part of that sentence particularly. But Lloyds has got its Blueprint 2, which is talking about basically creating this data-driven electronic placement that goes all the way up. The ecosystem that goes all the way from front to end in terms of the transaction that will drive efficiency into the industry. Every single entity in Lloyds and beyond in the London market is investing very heavily in terms of technology and human resource behind that advancement. The market wants to be more efficient, it wants to be closer to its customer, and it wants to create value or bring products to those customers that this type of structure would enable us to do, whether it's because it's homogenous in terms of product, whether it's because the pricing is small increments, it's smaller amounts of premium. It's about enabling growth with that platform as well as increasing efficiency. So I think that's the top of everybody's list at the minute is that drive for technology.
Sorry. Somebody else gonna. So with technology, that's great. And then obviously, right now there's a lot of talk about D&I. I know when I started, I was the first female broker at Cooper Gay, and it was about a year after women were allowed to wear pants or trousers, in Lloyds. A lot has changed in those. In the meantime, what is Lloyds doing to help in this area, or to change in this area?
Well, I'm not going to necessarily talk for the corporation because it's in the sheets. I mean, as you say, it's on the internet. The market's moved a long way since I've been in the marketplace. I mean, as you say, there's a lot more diversity in there, but there's a general acceptance that we're on this road and more needs to be done. And I do sense that it's at the top of everybody's agenda, as you say. Therefore, the impetus will continue to improve. And in all honesty, this isn't being twee. You know, everybody's working environment has improved. You know, back in the day when you started, it was a very adversarial marketplace, even as little as 20 years ago. And everybody's life is a lot richer for it being there. But we've still got work to be done. There are targets that Lloyds are setting to try and improve.
They've made it publicly accountable, you know, so that the market's made it publicly accountable about the culture and surveys, and you know, gender targets, etc. And it is improving, and I think all of us agree it needs to improve further. And we continue down that road. It's very important.
Yeah, it continues, as I say, it continues to improve, and you know, we are seeing you know, a marked difference in acceptability, and I think that's only for the better. So yeah, as Justin said, it's the facts are in the Lloyds have publicly issued documents on that, and you know, they're freely available. But we can tell you from where we sit and the way that we build and manage our businesses, it's changing markedly, which is really good news. Clearly.
That's great, and it's an industry thing, right? It's the industry has a long way to go. So
it's not just in the UK either. I mean, we see a great diversity of clients, brokers, retailers. You know, and actually that makes our life a lot richer in terms of knowledge and what we actually get from that. And that's again sounds as though it's a cliche, but it's not. And that's the important part about our industry. You know, that's pretty special. And I think. I know we've got a 3-minute warning now, haven't we, Emma?
Yeah, so I was going to say to you guys, is there anything, we have a few more questions, but why don't I let you guys hit on anything you particularly would like to before we close?
Well, the thing that I would like to talk about more than anything else, and you know, COVID's definitely heightened our understanding of what we've missed about being in this sort of collaborative environment. And it's not just, again, about Lloyds being the centre of it, but the City of London and the exchange of knowledge, and we'll talk about
learning.
Yeah,
we're you know, have we stagnated? You know, the underwriter sitting next to you, the knowledge you learn from a claim, from the claims person. So Richard and I were talking earlier. You know, we want to get back together. The market is so good together, and how do people learn? And how do we pass that knowledge on, which we have a responsibility to do? So, you know, that's we're passionate, and you know, come the middle of May, we're back in the room, and I think that can only be, and we've really missed our clients, and they're the wholesalers, the retailers, the cover holders. We have really missed the clients.
I know we've got some questions I think Enya wants us to answer, but I think, you know, when people ask me what I do for a living, you know, traditionally people just sort of go, insurance and claims over. This is a fantastic industry, right? There's a lot of opportunity for individuals, whatever side of the fence you're on. It's totally misunderstood. And I think, you know, the value of that is in the next generation of people that are coming through into the city and globally as well. And I don't think we should give up. I don't want to be part of that generation that just goes and doesn't give that next generation of people the opportunity to have what I've had in terms of a career.
And I think what would I say? You know, I think the staying at home, the lack of connectivity, although we have been electronically, I think that's been severely missed across our business, particularly in the youngsters. Younger people have found it a lot harder. Why? Because the learning has been a lot more difficult across. You know, I think the value of sitting, listening, hearing, eavesdropping, a phone call, a meeting, why don't you come to this? All those things that we do subconsciously have gone. You know, all that value has gone. All the travel has gone. You know, I never thought I'd say this, but going to a Whistler or what was NAPSLO, those massive conferences. There's value in that, and it's missed. It's missed for the business, and we really want to get back out there and reconnect, and both for what we do internally, but what we do collectively. And we need to, word passion's been used a lot, and I passionately want London Lloyds to reopen, the doors to reopen, and us to return, stronger and better for this. It's a vibrant place. I don't want us to come back in dribs and drabs. I don't want us to do Wednesday or a Thursday. I want us to come back and do it properly and do it better.
Right.
And everything that we've learned, the advancement of the marketplace, the electronic trading, all the enhancements, I want the best of everything. And that's how I see it.
Okay, so we have a few questions.
Yeah.
So let me start at the top, and whoever wants to answer it, go ahead. The property premium income what's property premium income expected to be for 2021 split between direct fact and cover holder business? Any idea?
I'll give a stab. So if the property premium sterling last year was £10 billion approximately, I think you'd find about 35% would be cover holder. So if you put your risk adjusted rate increase on last year's premium plus some new business, and then the split will probably be similar. So it could be a 70-30 split or 35-65, but you could see it's going to be closer to 15 than it is to £10 billion.
Yeah,
I would suggest.
That's great. What can you guys comment on Lloyd's engineering capabilities in contrast to a Swiss Re, FM, AIG?
I thought. Well, I defer to you, gentlemen.
It's a key differentiator, I guess, in that that is exactly what the US companies bring to the table. We partner with all those carriers that you've mentioned, and they charge the clients the service. We don't have engineering, the facilities or abilities as a market base, and we do rely on that third party to provide that. And there's also independent ones in the US as well. But it's a capability that we're missing, but we're not geared up to do that. We're not, we have 6 people in our underwriting team. We're not 600 people, and that's the difference of scale, I think.
Okay. Another one is basically, how do you build long-term stability and financial smoothing via risk transfer? What could be done to achieve better long-term stability to the benefit of insureds and insurers?
I'll have a go at some of that. What would I say? I mean, the pitfalls of underpriced insurance are low deductibles and attrition that really destroy our loss ratios. I think if you want long-term stability in pricing, which I think was what you were asking, I mean, you need to take a grown-up attitude to retention and levels of retention. And the difference between an insurance policy and a maintenance policy is fundamental. So I think Alastair alluded to at the very beginning the improvement in the underlying loss ratios, the attritional loss ratios. That's a really important part of our jigsaw. And it all ultimately comes down to the difference between expected losses and attritional losses. I think taking grown-up retentions, in my opinion, is the way to help take out some of the unpredictability of the pricing. But if you play the market and run right down, you're entering a world that it makes it very difficult. So that's probably the one thing I would say.
If you go in and out the market, your pricing is going to be more volatile. So longevity comes with, there's some price stability with buying for 5, 10, 15, 20 years, and not many clients like that. They will get lesser increases than the market. And if you come in and out, sometimes that capacity is not available, particularly if it's say, for example, you need to buy more flora cover. So pricing will fluctuate, but longevity you can get from Lloyds.
Yeah.
I haven't got anything to add. I mean, it's exactly that. The lower end of rate increases that we've been given to people that we've been with for 10 years, right? So it's an obvious mathematical thing, right? And they do have the greatest ability in pricing.
Okay, thank you guys. We briefly touched on this, but obviously with the pandemic, it's had an impact on recruiting and bringing younger people in and through the business. What advice would you give to people that are entering the market today, how to develop and how to grow with everything that's going on, and they can't use the traditional routes?
I mean, Emma, I think I'll jump in on that. I think you're right, but I've had that thrown back to me as I think younger people are incredibly resilient in the way they adapt. And that's not meant to be a flippant comment. I think the way that they interact, the way they socially interact, they're far more flexible about the way they live their lives, frankly, than we would be. That being said, I think it's a very, it is difficult. This has been a wholly difficult process. But, I think it's been I think all I would say to young people who ask me, I said, use your time wisely. This has been a great time to use your time to get your exams, to knuckle down. Yes, we've missed the social. Yes, you've missed the interaction in the office and the clients and the travel. But there's plenty of other things within that to improve your skill set. That's what I urge my team and my guys to use their time wisely.
I think it's extremely, like we said, it's extremely difficult. I think you'd almost learn. Without, you could turn to someone and ask a question, you're just learning by instinct and by overhearing people being collaborative, and you're involved in meetings. And, this sort of format doesn't do that for everybody. But I would say to people, ask questions. I know it's a simple thing to do, but make sure that whoever's just employed you, whoever's your mentor, is giving you time for you to ask those questions, and don't be afraid to do that. You're not going to know everything, even if you've come out of insurance school. You're not going to know this stuff, because there's lots of different abbreviations, lots of acronyms, lots of terminology that people use and take for granted that you will not understand unless you have somebody to ask. And I think that's the biggest thing that people are missing in their advancement. It has really set people back.
Yeah. All right, so I think we should end on probably the most important question of the day. Will the land be open on May 17th?
I think it is. I think it is, but I mean, it's not properly open because you can only go in with appointments and you have to do. And this, I don't know. You're right. Who knows?
I think since you lined up in Lloyds and were very patient, I think so much has changed, and I cannot see many of us in this room having a break until we get through to July. There is a great opportunity, and we need to provide a service and deliver to our clients. We are absolutely flat out, which is great, and we don't mind. So the land's going to have to wait, but I think we'd rather see our colleagues back in the office and the clients back in Lime Street first. So the land will wait. Next time you're over, we'll take you there.
Yeah, the world has moved on from the land, and it has moved on.
Sorry.
So it's an important distinction to make. I know what you're referencing, but it's a different world now.
Yeah,
that's what I would say.
All right.
Very good.
Thank you guys all so much for your time. We appreciate it.
Thank you.
Well, I hope it worked well. I think we enjoyed it here. It seemed to be a better forum for having us all in one room. That seemed to.
It's nice to have some company. That's all.
Yeah. I'm still writing supermarkets at 4%. So
I have a couple. I'm sending them this afternoon. Thank you guys. I'll pass you back to Enya.
Thank you so much, Emma. Thank you, Emma, Alastair, Justin, and Richard for the very informative sessions and your insight into the marketplace. Special thanks to all of you for your passion. I think the word was said a lot, which is contagious and it's inspirational. So is your commitment and leadership. So thank you so much for bringing that to us today. And thank you everyone for being part of this ongoing conversation. Please join us next Tuesday. We'll resume our syndicate showcase session. We'll showcase Ascot as a syndicate next Tuesday. Andrew Brooks, CEO of Ascot, and his team will join us live from London. And if you have time, a few minutes, just take a short survey at the end, give us your comments to help us for future programming. Again, thank you everyone. Let's stay connected, and we look forward to seeing you live on May the 17th in the Lloyds building.
Thank you. Bye-bye.
Bye-bye. Bye-bye.